This is Made for More Living with Johnny Jennings. Online at madeformorerealty.com.
So today we are talking about taxes. It's coming up to be that time of year. If you're not thinking about them, you should be. And so on the show today, what's more fun? What's more exciting than taxes? Well, on the show we have Jana Reyes, and she's going to be talking to us about tax strategy, specifically what you can do with real estate. Thank you for being on the show today.
Of course. Thanks for having me. I appreciate it.
So real quick, let's just talk real briefly about your background, what company you're with, and what tax strategies you and your company specialize in.
So my name is Jana Reyes, and I'm with Asset Preservation Incorporated. We are a national 1031 exchange qualified intermediary, and we specialize in 1031 exchange, which is a tax strategy. It's a tax deferral strategy for real estate owners that hold real estate for trade, business, or investment.
So real quick, we don't have to get into the weeds. But you emphasize deferred. Why did you do that?
Well, I emphasize that because it is not a tax elimination strategy like some people think. It is tax deferral. So you're just simply kicking the tax can down the road, but it does allow you to grow your wealth, kind of snowball your wealth, because you are, instead of cashing out of real estate, paying the tax, and then having a lot less to reinvest on the back end, you're getting to grow the wealth by deferring that taxation. And so you have more to reinvest in new real estate.
Okay, so you're growing it, essentially tax-free, tax-deferred.
Tax-deferred.
Deferred.
Yes.
We got to make sure that's clear. What type of costs or how does the process work? Is it complicated or is it pretty simple to do a 1031?
It depends on who you ask. I feel like it can be very simplistic if the taxpayer is clear on what the rules are, because there are some very clear guidelines set forth in the tax code in terms of the timelines, in terms of the rules, in terms of what qualifies as like-kind for the like-kind exchange. So it can be pretty simplistic, but it can also get complex if people have a lot of moving parts. And so we do recommend that they call us before they even list the initial property for sale so that they can get educated on the process and have a high probability of success.
Got it. So who should call you? Is this just for commercial property? Is it residential property?
It's any real estate held for trade, business, or investment.
Okay.
Any real estate. Raw land, mineral rights, a cell tower, could be a commercial building, as you referenced. It could be single-family rental properties, or anything in between.
Got it. And so when they contact you, hopefully, ideally before listing the property, that's because there's timelines. There's some very strict timelines, right?
Very strict timelines, correct, yes. And if you blow the timelines, you blow the exchange, and you're on the hook for the taxes.
So I had a gentleman years ago, maybe 2 years ago now, who came to me and was like, Johnny, I'm doing a reverse 1031 exchange. If somebody blows the timelines initially, can they back into it, or are they stuck?
So if you blow the timelines on a traditional exchange so let me just kind of give you an overview of what those timelines look like. So basically, you list the property for sale, you secure a buyer on the property you're relinquishing. Some people call that the down leg property, some people call it the relinquished property, but that's the property you're exchanging out of. Okay, so you list that property you're exchanging out of, and then before that, once you secure a buyer, you're in contract, then you engage with a qualified intermediary, which is what we are. We draft a set of exchange documents that effectively assign that contract to us, and then we create an account to catch the funds at the point of closing, because if the funds are directed at the taxpayer, then they're realizing the gain and they're going to be on the hook for the taxes.
That's where the intermediary comes in.
That's where the intermediary comes in. Yeah. So basically, we are stepping into that contract, and we are catching the funds and holding them away from that exchanger so that they do not have constructive receipt of the funds during this process. And then we hold those funds until they have identified their replacement properties and tell us who's closing those properties. And that way we can channel those funds to the closer handling the purchase of the replacement properties. But all of this has to happen within a certain timetable. So not only do we have to hold the funds away from them so they don't have constructive receipt, but we also have to make sure that they are reinvesting within the timelines. So you have 180 days after close of escrow of the sale of the property you're relinquishing to reinvest and have that new real estate held title the same way that you held title to what you just relinquished. But of the 180 days, the first 45 is called the identification period. And you get 45 days to unambiguously identify what it is that you're going to purchase.
Yeah.
And then you must purchase something off of the list that's been created by day 45. And so if you fail to buy something off of the list, the exchange is blown. Or you fail to identify anything by day 45, your exchange is blown. Or if you fail to, reinvest the money by day 180, then your exchange is blown. So you have to meet the timelines of the exchange period outlined in the tax code.
Oh my gosh, that sounds super stressful. But that's why we need to talk to you first, right?
Right. Well, some people think it's stressful because they don't plan, right? But
Yep.
people who plan ahead usually have a good probability of success. And what happens in the real world is most of the time, once they list the property they're going to relinquish, then they start looking for replacement property right away. They don't wait for the clock to start ticking on them, right?
Yeah.
So you can start searching for replacement property during the escrow of the sale of the existing property, and that clock doesn't start ticking until you close. So effectively, some exchangers find the replacement property and they literally close within a couple of days of their sale. We call it a simultaneous exchange if they can do it within a couple days of each other.
Okay.
If it takes longer to close the replacement, then it becomes a delayed exchange. And the delayed exchange, you have up to 180 days for the reinvestment. So to go back to your question about a reverse exchange, that's really a different animal, because what that is where you are actually buying the replacement property first and selling the relinquished property second.
Yep.
So it's a complete reversal of the process. Now, in order to do that, it gets a little tricky because the exchanger is not allowed to be on title to what they're selling and to what they're buying at the same time. So if they're buying first, they still own the property they're planning on relinquishing. So in order to buy first, they actually have to use something called an exchange accommodation title holder, an EAT. Okay. And we
EAT?
are that. Yep. EAT.
Okay.
And we are also that. So we're a qualified intermediary, but we're also an exchange accommodation title holder, because what we will do is we will create an entity on behalf of the exchanger. That's the exchange accommodation title holder, that entity. And we're the member of that entity instead of the exchanger.
Okay.
And then they assign the purchase agreement of that replacement property to us. We step in as that EAT and actually buy the property on behalf of the exchanger, because again, they can't be on title to what they're selling, what they're buying at the same time.
Are they typically buying cash or getting a loan?
Well,
or?
good question. Yeah. So it depends. Most of the time, we see exchangers who have a lot of resources and they're using their cash to make that purchase.
Okay.
Because obviously they haven't shaken loose the equity of what they're selling yet, right? So there's no money from that relinquished property yet to use to make that purchase. So they are fronting the money to make that purchase, but they're giving it to us, right? So we're signing a note saying that we're receiving their funds. We're making the purchase on their behalf in an entity we've created, right? And then we're effectively triple net leasing the property back to them so that they have the burdens and benefits of ownership, because we're not in the property management world. We're simply an exchange accommodation title holder in that environment. But they need to make sure that the insurance on that property covers us and them, because we're on title. And now we're holding title to that. And as soon as we close escrow on that purchase for them, that triggers the exchange timeline. And it's the same timeline. You still get 180 days, but instead of 180 days to reinvest in new real estate, you have 180 days to sell your existing real estate. And so when they sell that existing real estate, whether it's one piece of real estate or if it's 10, they need to sell those pieces of real estate within that 180 days, channel the proceeds of those sales through the qualified account, right? And then if it was their money that was used, we're returning their money to them, right, through that qualified account. And then we're deeding the new property to them.
Because now they don't own
by the 180th day, because now they no longer own the relinquished properties. So reverse exchange has a lot more moving parts, but we have a really skilled team at API that works on the reverse exchanges, the parking arrangement team, because it does require a lot of sophistication to make sure that all of that is done according to the tax code and it meets muster. But it is a process that we see more often in the commercial world than in the residential world.
Okay.
Sometimes people will do it with residential because they have very specific needs or inventory is really tight.
Yeah, like this individual, he wanted to buy a house for his daughter, and she didn't want to live in the house that he currently had, that they were currently at. So he had the extra resources, so he bought the replacement property. She moved in and was living there, and then he was going to sell the property he was going to do the reverse for. Got it.
And I'm assuming the daughter then was a legitimate tenant paying market rent so that the property would qualify for exchange. So that does happen, certainly, like where somebody who owns residential real estate and they want to reinvest in residential real estate, and maybe there's a very specific property that they want to own and they haven't listed the existing property yet, and so they will take on a reverse. More often we see it in the commercial world, especially with business owners that are running their business from their piece of real estate. So, for example, if you're a dentist and you're running your practice from a piece of real estate that you own, and maybe your business is thriving and it's outgrown its space, the dentist isn't going to sell that existing building first and then have nowhere to operate from until they find a replacement. Instead, they're going to buy the replacement, move their practice, and then sell the existing property. So more often we see it in that type of environment where they're looking for business continuity, and so they really have no choice but to flip it into a reverse. The other time we see it is when somebody's trying to sell multiple properties and combine the proceeds into one replacement, like one larger replacement. Sometimes it's easier to buy that replacement and then have 180 days to sell all of the existing properties, because if you try to do a traditional exchange, a more like a delayed or a simultaneous, and you're selling multiple properties, the thing to know about that is that timeline, that 180-day clock, it starts ticking at the sale or the close of the first property, not the last. So if you're selling 5 properties and only one of them has closed and the clock's ticking and you're still trying to get the other one sold, that's where a lot of stress can take place. And so in that environment, we'll more often see someone do a reverse so that they have more time to sell the existing properties.
That makes sense.
So it's really all about the logistics on what makes sense. And that's part of why we're there, to educate people, because they bring us their circumstance. And if they bring it to us ahead of time, we can help them structure the deal in a way that they're, again, going to have a high probability of success. Now, that doesn't mean that people don't call us last minute, because we get a lot of that, too.
I'm sure you get a lot of those.
We get a lot of the...
Please fix my problem.
Yes. In fact, I sadly had one the other day, and the gentleman had already closed escrow on his sale, and his realtor actually had given him a card for our company and said to call us, but where the realtor failed him is he did not explain that you needed to open the exchange prior to close of escrow. So he called me and said, I'm ready to set up my 1031. And he said, I closed. And I said, wait a minute, closed? You mean closed? Or are you pending getting ready to close? Because if you're pending ready to close, we can draft the exchange documents and open the account. And he said, no, I closed. Like I'm recorded, done.
Ouch.
Yep. And once you're recorded, there's, you're on the hook for the taxes. So it's super important to make sure that you engage with a qualified intermediary prior to close of escrow of the sale.
So if somebody's listening to this and they think, hey, that sounds interesting, I want to do that, what's the best way for them to get a hold of you?
So they can either go to our website. We have an amazing website, apiexchange.com. We have a lot of resources on there. So if anyone wants to get educated on exchange prior to calling us, they're welcome to do that. There's a lot of resources there. They can call our headquarters, which is 1-800-282-1031.
Perfect.
1031 at the end there. They can email me at jana@apiexchange.com. I'm happy to talk to anybody about their prospective exchange or help them last minute. It just has to be prior prior to close of escrow.
Prior to close. So
Yes,
if you heard
prior to
nothing,
close.
if you got nothing else out of it, forget about the days. Make sure you talk to Jana before you
Yes.
receive the funds, before it closes.
Yes, before it closes escrow. Yeah.
Wonderful. Well, when we come back, there is so much more to talk about. We're going to be talking about 1031s and specifically other ways that you can, other tools, resources. What would you call it, Jana? The DSTs, REITs, all
So
that.
we're going to talk a little bit about all of the types of properties that qualify for 1031 exchange reinvestment.
Wonderful. Back after this.
Hey, life is all about relationships, right? And the team at Made for More, they understand that. They understand that when it comes to selling your home or purchasing a new home, it can be a very emotional, huge step in your life. It's one of the biggest transactions you will ever make. And so they want to develop that relationship with you. They want to walk with you every step of the process, make sure they are holding your hand, you're understanding everything clearly. And again, they want to develop that trust with you, that strong relationship, so they can help you during this important journey, this important stage in your life, selling your home or purchasing a new home. So here's what you do. Just Google Johnny Jennings with Made for More Realty. Read all of their 1,000 plus 5-star Google reviews. Find out for yourself the great relationships they have made with many of our listeners throughout the Sacramento region. So again, just Google Johnny Jennings with Made for More Realty and get more for your home.